This conference will now be recorded.
Good evening, everyone. I am Pete Panito, First Northern Credit Union's Business Development Contact. We have Director of Sales, David Tagnarelli, presenting today's webinar, Are You Financially Healthy? Everyone should have received the handout that was emailed earlier this afternoon. If you don't have it, let me know in the chat box and I will resend it to you. This presentation is part of our weekly financial wellness series in partnership with the City of Evanston. We will follow up with an email tomorrow with additional materials that will be presented today. In addition to the partnership we have with the city, First Northern Credit Union continues our free monthly financial wellness webinars as well. We have the webinar Understanding Credit coming up next week. If you'd like information on those, let me know and I will send you a sign up information. Throughout the webinar, if you have any questions, please ask them in the chat box and David will address them at the end of the presentation. We appreciate you joining us today. And with that, I turn the microphone over to Mr. Tagnarelli. It's all yours, David.
Great. Thank you so much, Pete. And thank you, everyone, for joining us today on our session, Are You Financially Healthy? So today's session, our goals, we hope to complete are to understand what it means to be financially healthy, which is so much more than the one score everyone asks you about today. And that, of course, is your credit score. Now, while there are lots of ways to check this score, it's really only one piece of the equation. True financial health is based on 4 key components, and those include spend, save, borrow, and plan. And we'll dig into each of those components during the presentation. You'll also get a chance to confidentially determine your own financial health score and the steps that you can take to improve that score. Now, your attitude and approach toward your money can impact your overall score, which has nothing to do with how much money you actually make, but really more about how you use and plan with your money. So what is financial health? Does a FICO score translate to financial health? Does having a savings account make you financially well? Or how about no debt? How about how confident you feel about your finances? So let's start with a definition. According to the Consumer Financial Protection Bureau, the definition of financial health is being in control of your day-to-day and month-to-month finances, having enough of a financial cushion or savings to absorb any unexpected expenses, being on track to meet your personal financial goals, and finally, enjoying the financial freedom without constantly worrying about money. So you'll notice that each of these aspects of financial health can influence the other. For example, if you do not have enough of a financial cushion when you experience unexpected expenses, you may feel as though you're not in control of your day-to-day finances. Similarly, if you are on track to meet your personal financial goals, then you will enjoy financial freedom without constantly worrying about money. By taking charge of several areas of your financial situation, you can improve your overall financial health. So what are the core aspects of financial health? One of the core aspects is having the knowledge of resources that will help you fund education and living expenses. By researching grants, scholarships, and loans, you will understand the different options available for funding education and will understand how those financial decisions can impact your overall financial health. Becoming aware of resources that will assist in covering living expenses will assist in freeing up funds that can be attributed toward other financial goals. The ability to maintain a balanced budget is an instrumental core aspect of securing your financial health. Sustaining a balanced budget is what ensures a strong financial foundation, without which you will likely find yourself in financial trouble. When you have a balanced budget, your expenses total less than your monthly income, and therefore you're able to save for other financial goals. Another important aspect of financial health is preparedness for all expenses, including short-term, long-term, and emergency expenses. If you have a savings that will satisfy your long-term goals, but don't have the funds to cover short-term goals, you may find yourself in a situation where the time frame for your short-term goal passes and that you do not have the funds. In addition, if you're only focusing on the short term and not planning for the long term, you may not have the funds to achieve your long-term goal. So it's vital to your financial health to plan for both. Emergencies can also derail even the best short-term and long-term plans. Although we may not be able to plan for exactly what an emergency may be, we can be sure that they're likely to come up in the future, sometimes when they're least expected. By having funds set aside specifically for emergencies, you can ensure that you don't have to use the funds that you've set aside for your short-term and long-term financial goals. So, does financial health translate into physical and mental well-being? So, some stats for the group. 85% of Americans are stressed about their finances and indicate that they can bring this stress to work, resulting in absence, health issues, and the inability to retire. Then 57% of all Americans are not financially healthy, which is over 138 million Americans. The majority of our country, regardless of income, can also not come up with $400 in the event of an emergency. This stress can definitely become debilitating, causing not only health issues, but also the inability to take action and plan for emergencies, and also happy events, like vacations, retirements, weddings, graduations, all the things that make life enjoyable. Okay, so here's the 4 core components of financial health. According to the Center of Financial Services Innovation, they include spend, save, borrow, and plan. These 4 components mirror your daily activities, and based on what you do, will either add or detract to your current and future financial wellness. For example, how well are you prepared for a car breakdown or an unexpected medical bill? Will you be able to save for college for you or a loved one, or go on your dream vacation without having to incur debt? Okay, so now we're going to uncover our own financial health score. So on page 5 of the handout that was provided prior to today's presentation, and let Pete know in the chat box if you didn't receive it, and he'll send it to you, there is a financial health assessment. So please take a few minutes right now to go through the assessment confidentially, and once you've finished, add up the scores and multiply by 2. So I'll give just 2 or 3 minutes now for everyone to complete the assessment. Okay, so I'm hearing from the group that I can't be heard. So please indicate in the chat box now if you can hear me. And it sounds like I'm getting responses that I can be heard. Do I need to start from the beginning of the presentation? Okay, great. So this slide here, we're just going through the financial health assessment on page 5 of the handout. So please take one more minute to complete the assessment, total your scores, and then double your final score at the end, and we'll review the scores on the next slide. Okay, so here's how the scores break down, everyone. So 0 to 40 is the poor range, 40 to 60 is fair, 60 to 80 is good, and 80 to 100 is excellent. So if you have good financial health, you may be effectively using financial products to build resilience or create opportunities, but could have some room for improvement as well. If you have poor financial health, don't worry, you can improve. You should explore new methods for managing your financial life, focusing on balancing income and expenses, mitigating risk, and of course, saving for the future. So now let's take some time to examine each of the core components and what makes up good financial health. So the first component that we'll cover is spend. So you are financially healthy when you spend less than your income and pay all of your bills on time and in full. So creating a budget is key to spending. In fact, we like to call it a spending plan to determine exactly where you want to spend. It might help to determine fixed expenses versus variable expenses. This will also help you get a handle on all bills and determine exactly where your money is going. Sometimes you'll be surprised where you spend your money. So start by reviewing all of your bills and financial institution statements, but also track where you might be spending small amounts of money throughout your day or over the course of a month. You'll be surprised at how that coffee, snack, or small toy at the grocery store can add up. Variable expenses are likely a spot where you can balance your spending plan if you're over in expenses. Okay, the second component is save. So you are financially healthy when you have sufficient living expenses and liquid savings and have sufficient long-term savings or assets. So creating emergency savings is a great first start to saving. You may think that you have to save a lot, but starting at even $10 a month is a positive start toward building a savings. And really, we're building a habit when we do that, regularly saving a set amount each month. So once you have set aside an emergency savings plan, the next step is to plan for long-term savings, which might be saving toward a specific goal or the start of retirement savings. If your employer offers direct deposit, this is the best place to start because you're creating an automatic savings habit. Another helpful tip is when you get a raise, a bonus, or any extra cash, don't spend it. So resist the temptation of spending it right away. Instead, put it toward one of your savings accounts immediately and don't even factor it into your spending plan. Okay, the third component is borrow. So you are financially healthy when you have a sustainable debt load and have a prime credit score. So a sustainable debt load is one that isn't causing you stress in meeting your monthly obligations. If you must use a credit card, make sure you have a plan to pay it off every month. As a general rule, your total debts, excluding mortgage or housing payment, should be no more than 10 to 15% of your take-home pay. With regards to your housing expenses, mortgage, utilities, maintenance on your home, It's recommended that that amount does not exceed 35% of your take-home pay. When applying for financing, you'll likely hear the term debt-to-income ratio, and this is referring to a consumer's monthly debt payments divided by their monthly gross income. The debt payments included in this calculation are mortgage or rent payment, in addition to all other debt payments reported on your credit report. Most lenders are looking for this ratio to be less than 43% in order to provide financing approval. Now, keep in mind that this ratio is based off of your gross monthly income, but when constructing your monthly budget or spending plan, you want to use your net income, so after taxes and deductions on your paycheck, and then stick to the recommended budgeting guidelines mentioned earlier. So prime credit is considered good credit by a lender. So let's talk about what that means. Okay, we're breaking down prime credit here. So credit score ranges vary based on credit bureau. Each credit bureau is different because they all have slightly different ranges. Now, the FICO credit score, which is the most popular model, ranges from 300 on the low end to 850 on the high end. Equifax credit scores can range from 280 to 850. Experian credit scores can range from 330 to 830. And TransUnion credit scores can range from 150 to 950. So every credit bureau, in addition to the FICO credit scoring model, which is the most popular, can have their own credit scores that they offer to finance companies. Consumers with scores at the highest ends of these ranges are considered to have super prime credit, and consumers whose scores fall just below that range are considered to have prime credit. For example, Experian classifies super prime credit as a score ranging from 740 to 830, and prime credit as a credit score ranging from 680 to 739. Borrowers with prime credit can expect to pay slightly higher interest rates than borrowers with super prime credit, since they are considered to have a slightly higher risk of not repaying their loans. And that's really what a credit score is. It's a measure of the amount of risk that you present to a potential lender. Having a prime credit score might even mean paying 1% more on an auto loan than a borrower with a super prime credit score would pay, for example. Having prime credit usually means you can get a new loan, and retain access to your existing credit lines even when the overall credit market is tight or conservative. Now, even in a strong economy where credit is readily available, prime and super prime borrowers receive most of the credit that banks and other financial institutions issue. So the consequences of having subprime credit can vary. For some consumers, it may mean having to pay higher interest rates for mortgages, auto loans, and credit cards. And for other consumers, you may not qualify for conventional loans at all, which will require you to turn to riskier and more expensive ways of borrowing, such as payday loans or car title loans. So how is your credit score calculated? This chart here illustrates the different components of the FICO credit score and the percentage weighting of each component. This is helpful information to understand and can drive your overall score, both in the positive and negative direction. So I'll cover them briefly here, and we do have other presentations specifically on understanding credit, including one that we'll be presenting next week. So payment history. Payment history is the highest weighted factor of your credit score. It represents 35% of the weighting. And basically it measures, have you paid all of your credit accounts on time? And on time is defined as no more than 30 days late after the due date of your loan or obligation to a lender. The next highest weighted factor is the amount owed, and that represents 30% of your total credit score. So really, here we're looking at how much you owe total and how much of your available credit on your revolving credit lines, like credit cards, that you've used. So for example, if you have $1,000 in available credit, your credit score will be more positively affected by the lower balance you keep. So if you only keep $300, it'll be more positively affected than if you keep $500 or closer to the limit. And if you keep zero of your credit lines balances, then that's going to have the most positive effect on this weighting factor of your credit score. The next highest weighted factor is your length of credit history. It represents 15% of your total credit score. And here we're looking at how long have you been using credit. So this really is an average of all of the open trade lines that you have in your credit report, so existing accounts with lenders or other financial institutions, as an average. And the longer that length of credit history is, the more of a positive effect this component is going to have in your credit score. Then the last two, tied at 10%, are types of credit used and new credit. So here, with types of credit used, we're looking for a mix of different types of credit, including credit cards, retail credit, student loans, mortgages, auto loans. The more of a mix that you have, the greater positive effect it's going to have on your credit score. And finally, new credit also represents 10% of the weighting of your score. So here it's looking at how much of your available credit is new, where the dates of the credit being established are very recent. And this is also where the inquiries can have effect on your credit score. Now, I know there's lots of caution out there about checking your credit, but keep in mind that your score can rebound rather quickly after checking your credit once or twice within a 24-month period. Okay, so let's talk about some tips to improving your credit. So the first tip is to keep balances low on your credit cards. You want to try to keep your balances at least under 30% of the available credit limit. That's where it's going to start to have a nice positive effect on your credit score. And the lower you keep on your balances, the better. Next, instead of moving debt around, work on a plan to pay it off. So when you do a balance transfer from one credit card to another to take advantage of a lower rate, it could negatively impact your credit score in two ways. One, with the inquiry that comes from opening the new account, and then a second time if the balance is close to the new credit limit on the new card. So rather than continuing to constantly move that credit card debt around, it will likely be more effective to focus your energy on paying down those balances. Another tip is don't close unused credit cards as a short-term strategy to raise your score. Closing those accounts can actually hurt your credit score because it's going to shorten your length of credit history that we discussed earlier. Fourth, don't open a number of new credit cards that you don't need, just to increase your available credit. It's recommended for consumers to have between 2 and 4 credit cards, but it's important to only open the cards that you actually need. If you open too many cards, you could put yourself in a situation of having too much available credit, which could be seen as a risk to some potential lenders. It's also important to note that repairing bad credit is a bit like losing weight. It takes time, and there's no quick way to fix a credit score. In fact, out of all the ways to improve a credit score, quick fix efforts are the most likely to backfire. So beware of any advice that claims to improve your credit score fast. The best advice for rebuilding your credit is to manage it responsibly over time and really just focus on making those payments on time and paying down that debt. If you haven't done that, then you need to repair your credit history before you can see credit score improvement. Okay, so some tips to getting out of debt. Make a list. So having everything written out in front of you is really the key to success here. Plus, once you've written it all out and it's right there in black and white, it may not seem as insurmountable as it did before. Make a list of all your debts. So the name of your creditor, the interest rate on the debt, the balance owed, and the minimum monthly payment. Also, list how much you'll need to pay in order to zero out the card's debt within 3 years. And that can be found right on your credit card statements and give you a nice plan to pay off that debt. Second, work on lowering your rate. So paying high interest rates on existing debt can cause your debt to really mount and makes it paying off much more difficult. If possible, you want to lower those interest rates. So based on your credit, you may qualify for much better interest rates on credit cards. One way to do that is simply call and ask. So call your credit card company and see if they'll offer you a lower rate. Also, you can check into consolidation loans or refinance options for auto and mortgage loans. And the credit union is here, and we're a great place to start to see if we can offer you a lower rate on existing debts. So please reach out and let us know if you want to check into that. Third, you should know how much you owe. So once you know what your total payoff number is, you'll have a real, complete goal to work towards. Total the 3-year payoff amount for all of your credit cards, then add the monthly payments for all other debts. This amount is now your new total monthly payment for debt obligations. Fourth is plan your strategy. So there are plenty of ways to attack this problem, and you'll likely approach this using a variety of tools and methods. Plan your strategy carefully. Determine if you can actually afford to pay the total monthly payment until your debt is paid off. If not doable, you can contact a credit counseling agency and/or a bankruptcy attorney for advice. And we'll talk a little bit more about some resources that we have for credit counseling that are free. If doable to pay off those debts, decide which debt to pay off first. Then set up an automatic payment for required minimum for all other debts besides the target debt. Pay as much as possible toward the target debt until it's paid off. Once that happens, choose a new target debt and pay extra towards that one, and so on and so forth until all of the debts are paid off. Fifth and finally is to monitor and adjust. So once your plan is set, don't get too comfortable. You'll need to track your behavior closely to make sure that you're making progress. And you'll want to make adjustments when necessary. As you go along, monitor your credit score each month to see if your credit score improves. Over time, it definitely should. As your credit score improves, you can then reconsider that consolidation loan or balance transfer I mentioned before in order to save money often spent on the interest charges for remaining debts. But remember, if you're working on improving your credit score, then a consolidation loan or balance transfer may harm it. So you want to balance that out. And the credit union is a great place to go and ask for advice on these topics. But if you're solely focused on reducing your debt, then a consolidation loan or a balance transfer could definitely be worth it. Stick with your plan until your debt is paid off. As you begin to work this system, keep in mind, it's not easy. Just like I mentioned before with losing weight, losing your debt takes work. But if you genuinely want to shed that stressful debt, your perseverance can make it happen. And don't fret if you need to make adjustments along the way. Remember, this isn't about a quick fix. It's about changing your habits and behaviors so that you can achieve your financial goals. Okay, so now we're moving on to the final component of financial health, and that is plan. So you are financially healthy when you have appropriate insurance and plan ahead for expenses. So we all know, especially in these times, that life can throw many unexpected things at us all at once. While we usually can't stop these things from occurring, we can opt to give our lives a bit more protection through appropriate levels of insurance. Insurance is meant to give us some measure of protection, at least financially, should a disaster happen. There are numerous insurance options available, and many financial experts tell us that we need to have these insurance policies in place. Yet, with so many options, it can be difficult to determine what insurance you really need. Purchasing the right insurance is always determined by your specific situation, so it's important to get unbiased advice from a licensed advisor. And I would even suggest talking to many licensed advisors and comparing the options available. Some key insurance types that everyone should consider include life insurance, health insurance, auto insurance, mortgage and/or rental insurance, and finally, disability insurance. Planning ahead for expenses starts with budgeting and also getting that emergency savings plan started. Okay, so as we wrap up today's presentation, I like to call this the hit list of financial health. So you are financially healthy when you spend less money than you make, when you have enough to cover 3 to 6 months worth of expenses, when you can come up with $3,000 to cover emergency expenses, and this money could come from your savings, interest-free borrowing, or the sale of assets. You're financially healthy when you feel confident that you're on track to retire when you plan to. when you are paying no more than 30% of your monthly income towards outstanding debt, when your credit score is good, or you are actively taking steps to improve it. You're financially healthy when your financial planning horizon is longer than 1 year, and when your insurance policies provide you with enough cover in case of an emergency. Okay, so here's some great resources for everyone, and they're all free. So one is the Community Credit Union here in Evanston, First Northern. Our website is www.fncu.org. Then, through our partnership with the City of Evanston, we have a free financial wellness website located at evanston.balancepro.org. That website has resources around financial education and coaching and counseling. Next, the Consumer Financial Protection Bureau website is www.consumerfinance.gov. And finally, to review your credit report 3 times for free each year, you can visit www.annualcreditreport.com. Okay, and our partnership is with Balance, and Balance is the free financial education and counseling service provided through our partnership with the City of Evanston. So at evanston.balancepro.org, you can find services that include money management counseling, debt repayment options, free credit report review, and more. Okay, so that concludes the presentation tonight, and now I'm happy to answer any questions that have come up during the time.
Okay, David, it is Pete again, and yeah, we have a few questions. The first one, can you explain that debt-to-income ratio again?
Yes, absolutely. So debt-to-income ratio is a measure of your total monthly obligations, which would include your mortgage or rent payment, added to all of the minimum monthly payments on your credit report, and then that total is divided by your total monthly gross income.
Perfect. Second question. Do most financial institutions use a specific credit bureau?
Well, I certainly can't speak for most financial institutions, but I can speak for First Northern, and we happen to use the TransUnion Credit Bureau.
Okay. And now if you're trying to reduce the number of credit cards, what is wrong with closing the account as a long-term strategy?
So there's certainly nothing wrong with it. And if you no longer need the account, that's definitely a choice that you can make individually for your specific situation. But just bear in mind that when you do that, you lose the age of that account. That factors into your length of credit history and your credit report and your credit score. And you also lose the total amount of credit available that affects the factor of the revolving balances towards the credit limit, and also has an effect on your credit score.
Okay, perfect. And the last question, I hear the term hard pull and soft pull when it comes to credit reports. I'm assuming if I apply for a mortgage, that's a hard pull, yes?
Yeah, so when you authorize a lender or another business to quote unquote pull your credit for a decision about you, that is a hard inquiry on your credit report. Conversely, when you have an existing relationship open with a lender or another business, and you've basically authorized them to check your credit along the way, they'll do it through what's called a soft pull, which will not be located in the inquiry section on your credit report.
Okay, perfect. And that was the last question. So I want to thank everyone for joining us today. We always hope you walk away with a little bit more knowledge on the subject that we present and remind you of some basics you already know. We will follow up tomorrow with the PowerPoint that was presented today. And please email any questions that you may have in the future. I will let David have the final word, but I just want to wish everyone the best of health and positivity, and please stay safe during these very trying times. thank you and have a great rest of the week. David?
Yes, I want to echo what Pete said, and everyone stay healthy, stay safe, be vigilant, but smile too, and interact with one another, and remember that we're in a strong community together here in Evanston, always trying to look out for one another. We're so happy to be part of the partnership with the City of Evanston, and if you want to learn more about understanding credit, please join us next week on Tuesday night at 5:30. And there's information about those presentations on understanding credit located on fncu.org/seminars. So have a great night, everyone.
And David, before you go, I have one last question that came in. How quickly can you regain positive credit if you close an account? The card was too costly with an annual fee, and it was a card I wasn't using.
That to me, Pete, sounds like a specific situation question, but in general, it's going to depend on your other accounts that you have open and exactly when that average length of credit history is going to catch up to where it was before, and then of course also your total available credit limits on your credit cards versus how much you have outstanding as balances. So it's a very specific question to address. And if that individual wants to reach out to you or myself, I'm sure we could address it with them one-on-one.
Okay, perfect. And that's all, folks. Thank you and have a great evening. Bye-bye.